Okay, let's dive into this. For years, we've all debated what the perfect hedge is for a real-world crisis. We've run the models, we've done the back tests, but the Hormuz crisis? Well, this isn't a test. This is the definitive experiment, and it's running in real time. It's showing us exactly what works and what doesn't when the global system is put under extreme stress.
So this is the question. It's the one question every single institutional investor is scrambling to answer right now. And it's because this isn't some abstract debate about monetary policy or a conflict happening somewhere far away. No, this is a hot war that's directly impacting the physical supply chains that basically underpin the entire global economy. The stakes for getting this right have honestly never been higher. So let's get into the data. First up, the classic safe haven, gold. And yeah, it surged, blowing past $3,200 an ounce. Now, you might think that's a predictable move, and maybe it is, but who was buying it and why they were buying it, well, that tells a much, much newer story. Then, of course, you have the direct impact. Brent crude prices just went parabolic, jumping 80% from their pre-war levels. That's what happens when the world's most critical energy artery gets squeezed shut. And then there's this number. Just look at that. An absolutely astonishing 1,056% spike. Now, this isn't oil, it's not gold, it's the cost of ship insurance. And as we're about to see, it might just be the single most important signal in this entire crisis. So let's be really clear here. What we are all witnessing is the most important real-world stress test for hedging strategies and for alternative finance in general since the 2008 financial crisis. This is where all the theory meets a very harsh reality. And you know what? The results are completely rewriting the playbook for risk management. All right, let's start with the oldest hedge in the book, gold. Its performance was strong, no doubt about it. But what's really important is that it confirmed a massive structural shift that's happening in the global financial system. So you see a 14% move from 2,800 up to 3,200. That's significant. But here's the thing, it wasn't driven by the usual panicked retail buying that you might expect. The real story is about who was buying, and more importantly, why. And this quote just brilliantly illustrates the core thesis. The crisis basically acted as a massive accelerator for a trend that was already well underway. We're talking about state-level actors who are increasingly and very deliberately looking for assets that live outside the US dollar system. You see, the primary driver behind gold surge was aggressive buying by central banks, especially the ones you see right here. Think about it. Ever since Russian assets were frozen back in 2022, holding U.S. treasuries suddenly looks less like a risk-free asset and more like a potential geopolitical liability. So for these nations, gold held in their own vaults is the ultimate hedge against the weaponization of the dollar. Okay, now let's talk about our most controversial asset, Bitcoin. For years, its biggest fans have called it digital gold. And this crisis, it was its biggest real-world audition for that title by far. So how did it do? Well, the honest assessment is that the results were mixed. Yes, it definitely saw inflows from investors who were looking for a non-sovereign asset. But, and this is a big but, it also suffered from just extreme volatility. It was sometimes even moving opposite to what you'd expect because of weird liquidations in the crypto derivatives market. And, we can't ignore the very real infrastructure risk. If the internet goes down in a conflict zone, your digital gold is suddenly inaccessible. But, the biggest hurdle for institutional adoption really comes down to liquidity. A $13 trillion market like gold can absorb massive capital flight. A $1 trillion market, it just can't. Not yet. I mean, for a pension fund trying to hedge billions of dollars, the exit door is simply too small right now. So the audition continues, but Bitcoin hasn't won the part. Okay, so let's move beyond just storing value. Where were the real opportunities to generate alpha, to actually outperform the market in all this chaos? Well, the answer lies in looking beyond the headlines and finding the purest signals of disruption. So the crucial takeaway here is this. Direct exposure to the affected commodities was the winning trade, not energy stocks. I mean, even a giant like Saudi Aramco suffered. Why? Because while the price of oil was skyrocketing, its ability to actually export that oil was severely impaired. The real winners were those with pure, direct exposure to the physical supply shock itself. Which brings us right back to this incredible number. That 1,056% spike in war risk insurance premiums for ships. It wasn't just a symptom of the crisis, it was actually the key to understanding it and to trading it. So why is that? It's because the insurance market is where physical risk gets priced first. I mean, think about it. Before the futures traders and the equity analysts could even fully react, the insurers, the ones who actually had to underwrite the risk of a ship getting hit, they were already pricing in the true magnitude of the danger. It became the ultimate leading indicator.
And this gives rise to a clear, really powerful strategy. For sophisticated investors, the playbook became crystal clear. When you see those war risk premiums spike, that is your signal. It's time to go long the disrupted commodities and short the equities that depend on them. The insurance market, in effect, has become a brand new source of alpha. So after all that, after the most important stress test in over a decade, what are the key lessons for investors? Let's distill all of this down into a new updated hedging playbook. All right, lesson 1. Gold works. It's still the reliable safe haven, but now it's supercharged by this strategic imperative of de-dollarization. 2. Bitcoin is still proving itself. The promise is absolutely there, but the institutional infrastructure just isn't ready for prime time. 3. In a physical supply crisis, you need direct commodity exposure, not proxies. And finally, the most powerful new tool in the box: keep your eyes on the insurance markets. They are a potent and seriously underappreciated source of alpha.
You know, this crisis wasn't a drill. It wasn't a test run. It was a live experiment that stress-tested every single asset class. It has shown us what works, what doesn't, and what's coming next. So really, the only question that remains is the one right there on the screen. What's your hedge?